The payments industry moves fast. The economics behind it move even faster. Welcome to On the Wire, a show about the economics of payments, the institutions moving money, and the infrastructure underneath it all. This episode is produced by payware using AI voice synthesis, built from primary research, technical documentation, and real market data. No studio, no hosts, just the content, clearly presented. Let's get into it.
Usually when we think about traditional banking, there's this underlying expectation of permanence.
Right, yeah. Like it's never going to change.
Exactly. We picture this massive steel vault. It's solid, it's heavy, and it's basically been sitting in the exact same spot, operating the exact same way for a century.
It definitely implies a certain kind of inevitability, you know?
Yeah.
We just view our financial institutions as the foundational bedrock of the economy. They don't move.
No, they don't have to.
Right. They just exist and we use them.
You put the money in, you take the money out, and they collect their fee in the middle. But if you look at the current state of global payment processing, the foundation beneath that steel vault isn't just cracking. It is fundamentally reshaping itself.
It really is. It's a seismic shift.
And the traditional revenue streams that built those vaults are drying up at just an astonishing rate. And if you're listening to this today, you're someone who likes to skip the surface level fluff.
You want to figure out how the machinery actually works.
Exactly. You want the deep dive. And today we have a stack of sources that pulls back the curtain on a very real, very urgent structural crisis in the banking sector.
Yeah, we're looking at a highly detailed business case and financial model from a company called Payware.
And it outlines the integration of account-to-account payments, or A2A.
And what makes this specific stack of sources so valuable is, well, the lack of corporate posturing.
Oh, totally.
It's just a raw, hard numbers playbook.
Yeah.
It exposes the actual unvarnished economics of modern banking and, frankly, why executives are panicking behind closed doors.
Okay, let's unpack this. Our mission today is to figure out why A2A payments are no longer just some shiny new tech feature a bank might, eventually get around to building.
It's way past that point.
Right. We're going to look at why this is an absolute existential necessity for any bank that wants to survive the next 10 years.
Survive being the key word there.
Seriously. But before we even touch on what A2A is or how it solves the problem, we really have to understand the pressure cooker these banking executives are trapped in right now.
We have to look at the slow death of traditional card acquiring.
Yeah. So to understand the sheer panic in the industry, you have to understand the mechanics of how banks have made money for, the last 50 years?
Pretty much, yeah. Every time you swipe a credit or debit card at a store, the merchant's bank, the acquiring bank, takes a small slice of that transaction.
It's basically a toll road.
Exactly. It's a toll road.
Mm.
And for decades, managing that toll road was a massive cash cow. But regulators, specifically in the European Union, have stepped in and aggressively capped those tolls.
The sources detail these EU interchange fee caps, and the numbers are just brutal for the banks.
Well, they're devastating.
They've capped the fees at 0.2% for debit cards and 0.3% for credit cards.
Which fundamentally breaks the traditional business model. Because when you cap the fee that drastically, you just destroy the profit margin.
Right.
Since 2015, those acquiring margins have compressed by roughly 30 to 45%.
Wow.
Yeah, nearly half of the profitability of this entire banking sector simply vanished overnight due to regulation.
And our source anchors this with a very specific real-world example of a mid-sized European bank. So this bank manages the payment processing for 18,500 merchant customers.
That's a solid portfolio.
It is. And currently, they're pulling in about 47 million euros a year just from these card acquiring fees, which on paper sounds incredibly healthy.
Right, but you have to look under the hood.
Exactly. When you factor in the margin compression and all these new competitors entering the space, this bank is projecting an 8 to 12% annual decline in that revenue stream.
Every single year, their pie is shrinking.
Yeah. It makes me think of an analogy. It's like these traditional banks are in the business of selling melting ice.
Selling melting ice, that's a good way to put it.
Because your core product's value is literally shrinking by the minute. Meanwhile, your new competitors, these incredibly agile fintech companies like Stripe or Adyen, are just walking around handing out free freezers to your customers.
Yeah, they're offering completely modernized technology while the traditional bank just sits there watching the puddle grow on the floor.
Right. And put yourself in the shoes of that bank's chief financial officer. A reliable 47 million euro pillar of your business is slowly dissolving.
And there's absolutely nothing you can do to stop the regulatory pressure that's causing it.
Nothing at all.
What's fascinating here is that dynamic is accelerating because merchant expectations have fundamentally evolved beyond just wanting lower fees.
Oh, absolutely. The fees are a huge pain point, yes, but merchants are also just suffocating under the structural limitations of the old card networks.
Think about the cash flow bottleneck of a traditional credit card swipe. If you run a retail store, you process a payment on Friday, but you might not actually see that money hit your bank account until like Tuesday or Wednesday.
Which is crazy in today's economy. Merchants today are demanding instant, real-time settlement.
Right. And they also want their software to actually talk to each other. They want modern APIs so their inventory system syncs perfectly with their checkout system.
And traditional banks are shackled to these legacy mainframe technologies from the 1980s. They just cannot deliver that seamless integration.
Which naturally leads to a breaking point. When you provide an outdated service that costs too much and operates too slowly, your customers find someone else who can do it better.
And that brings us to merchant churn. The merchants are packing up and leaving.
They're running for the exits.
Globally, the sources show that without any intervention, merchants are abandoning these traditional bank acquirers at an accelerating rate of 15 to 20% year over year.
Let's apply that 15 to 20% churn rate back to our mid-sized European bank.
Okay.
Losing those merchants to the agile fintech competitors translates to a devastating cumulative loss of 13.8 million euros over just a 3-year period.
Man.
It is a catastrophic leak in the hull of their business.
This is where we introduce the antidote. The solution proposed in this business case is account-to-account payments, A2A.
Right. Instead of running a transaction through the massive multi-layered obstacle course of a traditional credit card network, A2A creates a single direct pipe.
So the money moves instantly from the consumer's bank account directly into the merchant's bank account at the exact moment of checkout.
Bypassing the traditional card networks entirely is how you solve the margin crisis.
Because they're the ones taking the huge cut.
Exactly. When a bank offers A2A to a merchant, they aren't bound by the heavy infrastructure costs of the old legacy systems. Instead of charging the merchant the standard, 1.5 to 2.5% fee for processing a credit card.
Which really adds up.
It does. But instead, the bank can process that direct A2A transfer for a flat 0.5% fee.
That is a staggering difference for a business owner. I mean, we're talking about a 75 to 83% reduction in processing costs.
It's life-changing money for a small business.
Yeah. If you're operating a high-volume, low-margin business like a grocery store chain or a regional gas station, shaving that much overhead off every single transaction completely transforms your annual profitability.
And the financial relief for the merchant extends far beyond the transaction fee itself. Because A2A transfers move money directly without ever using a 16-digit credit card number, the merchant is suddenly freed from the burden of PCI compliance.
Let's actually define that, because people hear PCI compliance and their eyes just glaze over immediately.
Oh, for sure. It's very dense.
It stands for Payment Card Industry Data Security Standard. It essentially means that if a merchant touches, transmits, or stores a customer's credit card number, they assume a massive amount of liability.
Right. They have to maintain incredibly secure servers, hire specialized cybersecurity firms, and undergo rigorous annual audits just to prove they won't get hacked.
Which costs a mid-sized merchant anywhere from 15,000 to 50,000 euros a year just to maintain.
Yeah, and A2A eliminates that entire category of expense because the toxic data, the credit card number, never exists in the transaction flow.
That's amazing.
And furthermore, it virtually eliminates the nightmare of chargebacks and dispute costs. The business case shows those costs dropping by 90 to 95%.
Wait, how is a 95% drop even possible? I mean, disputes happen all the time.
Well, they happen on traditional credit cards because anyone who steals a 16-digit number can make a purchase.
Right.
A2A transactions operate on a different security paradigm called strong customer authentication. To initiate an A2A payment, the consumer physically logs into their own banking app on their phone.
Oh, so they're usually verifying the transfer with biometric data, like Face ID or a fingerprint.
Exactly. So the bank has absolute definitive proof that the actual account holder authorized the payment.
Wow. So it completely neutralizes friendly fraud.
Exactly. Friendly fraud is where a consumer buys something, receives it, and then calls their credit card company to falsely claim they didn't make the purchase. With A2A, the biometric verification makes that argument impossible. the merchant keeps their money.
So from the merchant's perspective, A2A is cheaper, faster, more secure, and eliminates tens of thousands of euros in compliance headaches.
It's a no-brainer for them.
And the sources track what happens when our mid-sized bank finally rolls this out to their customers. The churn rate plummets from 9.4% down to just 3.8%.
And their Net Promoter Score, the metric measuring customer loyalty and satisfaction, rockets up 34 points, going from a 6.8 to an 8.2.
But wait, hold on a second. I'm looking at the mechanics of this, and something isn't tracking for me.
What's that?
If the bank is currently charging the merchant 1.5% to process a credit card, and they proactively walk in and offer to switch them to a 0.5% A2A rate, they're voluntarily slashing their own revenue by 2/3.
Right.
Why on earth would a bank cannibalize its own income like that?
I know. It feels counterintuitive to deliberately shrink your margin on a per-transaction basis.
Right.
But you have to look at the broader behavioral economics.
Right.
If we connect this to the bigger picture, it is infinitely better to cannibalize your own transaction fee than to let a competitor steal the merchant entirely.
Oh, because if you refuse to offer the 0.5% rate, Stripe or Adyen will gladly offer it.
Exactly. And then your revenue from that merchant doesn't drop to 0.5%, it drops to absolute zero.
And you lose more than just the payment processing fee, too.
Right. The sources reveal a fascinating shift in the underlying business relationship. When a bank integrates their core banking services with A2A payment infrastructure, they actually increase the merchant lifetime value by 3.2 times.
A 3.2 times multiplier, that's huge. That completely offsets the lower per transaction fee.
It offsets it because the relationship becomes incredibly sticky. If a merchant uses you solely for credit card processing, they can fire you and switch to a cheaper processor in about 2 weeks.
It's purely a transactional vendor relationship.
Exactly. But if you're the institution providing their business checking account, delivering their real-time cash flow analytics, and powering their integrated checkout system all under one roof,
the switching costs become massive. You aren't just a vendor anymore, you're their central nervous system.
you transition into a core infrastructure partner. The merchant stays longer, they use more of your financial products, and the cumulative value of that relationship just skyrockets.
The defensive logic is ironclad. You stop the bleeding, you give the merchants the modern tools they're begging for, and you secure the relationship for the long term.
Yeah.
But I want to look at this through the lens of the chief financial officer who has to actually sign the checks. The business case provides a full 5-year financial projection for this implementation, and we really need to walk through the hard math to see what this actually costs versus what it returns.
Right. For our mid-sized European bank, the strategic objective is to pull that declining 47 million euro revenue stream out of its nosedive and grow it to 59.4 million.
So they're aiming for a 26% gain over 5 years.
Yes, but the CFO has to navigate year one first, which is entirely an investment phase.
Building the bridge before you can cross it. What does that initial investment actually look like?
It requires absorbing a net loss of about 725,000 euros in the first year.
Yeah, that covers the upfront implementation. So integrating the core banking platform, building out the API connections, conducting rigorous security reviews, and training internal staff. It also includes the first year of ongoing operational costs.
I mean, signing off on nearly €1 million in negative cash flow right out of the gate is a tough sell in any boardroom.
It is. But then we hit the year 2 projections, and the adoption curve completely changes the conversation.
Year 2 is the inflection point, right?
Exactly. As merchants begin pushing A2A at checkout to save on their own fees, the bank's processing volume scales rapidly, hitting 1.55 billion euros.
Wow.
And because of that volume surge, the bank recoups its entire initial investment incredibly quickly. They achieve a full payback period in just 14 months.
Let's pause on that because 14 months seems shockingly fast for an enterprise-level technology deployment.
It is practically unheard of. In traditional banking infrastructure, core system upgrades typically carry a payback period of 5 to 7 years.
Breaking even and turning profitable in just over a year is basically a unicorn scenario for a bank CFO. By the end of year 2, the bank is netting nearly 10 million euros in positive value.
And the momentum just continues to compound. Let's fast forward to the year 5 benchmark. As A2A transitions from a new feature into a fully mature, normalized payment habit for consumers, the bank is projecting a net positive value of 37.74 million euros annually.
The cumulative 5-year math is where the full picture of value creation emerges. Over that half-decade, the bank generates just over 79 million euros in pure net new A2A revenue.
That's incredible.
But there's a secondary line item in this financial model that tells the real story of why this strategy works.
Here's where it gets really interesting. It loops back to that cannibalization worry we discussed earlier. The model includes a specific calculation for retained card revenue.
Right.
And that represents the traditional processing fees the bank continues to earn from merchants who stayed with the bank specifically because A2A was offered as an option.
That retained revenue equals 24.7 million euros over the 5 years. It's the hidden value of defensive strategy. You aren't just calculating the new money you generate. You have to calculate the old money you successfully protected from competitors.
Yeah. When you add the 79 million in new A2A revenue to the 24.7 million in protected legacy revenue, and you subtract the operational costs over that period, the bank is left with a net 5-year value creation of 97.84 million euros.
Which is massive.
The return on investment is 12,359%.
And the sheer scale of that ROI makes the strategic decision obvious. Any executive looking at that model will immediately recognize the necessity of adopting A2A.
They'd have to be crazy not to.
Right. But that leads to the final and most complicated hurdle, which is the execution choice. Recognizing that you need the technology is easy. Deciding how to acquire and deploy that technology is where banks usually stumble.
It's the classic dilemma in tech. Do we build it ourselves or do we join an existing platform? The sources dedicate a lot of analysis to this execution matrix, and a contrast between the two paths is stark.
Let's examine the build pathway. If a bank decides they want to own the entire stack and build a proprietary A2A infrastructure internally, the capital requirements are massive.
How massive?
The model estimates an upfront cost of 8 to 12 million euros.
Wow.
Yeah, and it'll require a dedicated full-time team of 15 to 20 specialized engineers and compliance officers. And it'll take 24 to 30 months before a single transaction can even be processed.
And once it's finally built, you're still burning 2 to 3 million euros a year just to maintain the code and keep it secure. You endure a negative ROI for up to 5 years.
Right. The alternative is the joint pathway specifically, plugging into an established transaction resolution network like payware.
Okay.
By leveraging existing architecture, the upfront cost plummets from 12 million down to just 785,000.
That's a huge drop.
And the deployment timeline shrinks from nearly 3 years down to just 6 to 9 months. And the maintenance burden is completely replaced by predictable annual licensing fee.
I really love the analogy of a power grid here. Choosing to build your own proprietary A2A system is like a factory deciding they need electricity, and rather than connecting to the city grid, they try to build their own private coal plant.
Exactly.
They have to mine the resources, build the turbines, string the transmission lines, and hire a team to manage the generators. Why would you ever take on that massive operational burden when you can just pay a connection fee and instantly access the existing electrical grid?
And the infrastructure analogy highlights the biggest flaw in the build strategy. If you build your own private power plant, it only powers your specific building.
Right.
If a bank builds a proprietary A2A system, it's a closed loop. Only customers who bank with that specific institution can use the system to pay merchants who also bank with that institution.
It's an isolated island.
This raises an important question, right?
Yeah.
Because when a bank joins a shared transaction resolution network, they instantly unlock network effects. The moment a bank plugs into the system, their consumer banking app becomes a viable payment method at every single merchant already connected to the network, even if those merchants were onboarded by completely different banks in different countries.
The utility of your bank's mobile app explodes overnight. You aren't just handing your customer a slightly faster way to pay their local grocer. You're handing them a digital passport that works across a massive interconnected ecosystem.
Which is why the decision framework in the source material is so definitive. It concludes that 95% of banks have absolutely no business trying to build this internally.
Makes sense.
The only scenario where building makes mathematical sense is if an institution already possesses over 50 million euros in annual acquiring revenue, and they can somehow afford to bleed merchants for 2.5 years while their engineering team tries to get the system online.
And based on the churn metrics we covered earlier, with merchants leaving at 15 to 20% a year, a 2.5-year delay isn't just a strategic pause, it's a death sentence.
By the time your proprietary system goes live, half of your merchant portfolio will have already defected to a competitor who plugged into the grid years ago.
So what does this all mean when we zoom out? The core takeaway from peering into this financial model is that account-to-account payments are not some distant theoretical phase of financial technology. This is a present-day imperative.
It's happening right now.
The floor beneath the steel vault is shifting as we speak. The banks that recognize the shift and move early will capture the merchants, integrate deeply into their daily operations, and dominate the ecosystem through shared network effects.
And the banks that move late.
New ones desperately clinging to the melting ice of high interchange fees. They will slowly bleed out their merchant base until the math simply collapses on itself.
It's the anatomy of a paradigm shift. But as we wrap up this analysis, there is a fascinating ripple effect embedded in this transition that the business case only hints at, and it has massive implications for the everyday consumer.
A downstream consequence. What is the ripple effect?
Well, we spent this entire time looking at how A2A saves the merchant 75 to 83% on processing costs by eliminating those heavy interchange fees.
Right.
Merchants are going to be heavily incentivized to push consumers away from credit cards and toward direct bank transfers at the checkout counter. But think about where those traditional interchange fees actually go today.
Okay.
That massive pool of money collected from merchants is exactly what funds modern consumer credit card rewards. It's the fuel for the airline miles, the hotel points, and the 2% cashback offers.
Oh, wow. If the merchant stops paying the toll booth stops handing out reward.
Exactly. If A2A becomes the dominant, virtually free payment rail for merchants, the funding mechanism for traditional card rewards completely evaporates. What happens to consumer spending habits when the points disappear?
That's a great point.
If your local supermarket offers you an instant 2% discount on your groceries for using A2A, do you abandon your credit card? Does the death of high merchant fees inevitably trigger the death of the credit card reward system as we know it?
That completely changes the stakes for the average person.
Yeah.
You fix the structural foundation for the bank and the merchant, but in the process, you might completely rewrite the psychology of how consumers spend their money.
It's a huge chain reaction.
It's a brilliant reminder of how deeply interconnected our financial infrastructure really is. Pull one lever to save a bank's profit margin, and suddenly millions of people have to figure out a new way to afford their vacation flights.
Yeah.
If you're listening to this and you rely on those airline miles, pay very close attention to how quickly the stores in your neighborhood start pushing QR codes and instant bank transfers at the register. The shift is already happening.
It's already here.
Thank you for joining us on this deep dive. We always appreciate the learners out there who are willing to roll up their sleeves and examine the complex machinery running quietly in the background of our daily lives. We'll be back soon to unpack another stack of sources and find the hidden connections. Until then, keep asking questions and don't assume the ground beneath you is as permanent as it looks.
That's On the Wire, produced by payware, the transaction resolution network for instant A2A payments. This episode was AI generated from payware's published research and documentation. If something sparked a question, the full source material is available at payware.eu. If you work in payments at a bank, an ISV, or a merchant organization, and what you heard is relevant to what you're building, reach out. The conversation doesn't have to stop here. Subscribe to On the Wire wherever you listen to podcasts. The next episode is already waiting.